Welcome to Digital Asset News, or Dan for short. My name is Rob, and I don't want anybody to freak out, especially for this first story that we're going to cover, which is Bitcoin failed to make a block for over an hour, and a bunch of miners were selling. So we're going to go over and just get the best information that we can and go from there. And let's just start that right now, because I think it gives a lot of people a lot of angst. So this is what is happening there. So the Bitcoin blockchain failed to produce a block for over an hour. Usually Bitcoin blocks are produced every 10 minutes, but apparently this is normal over 30, 33, 34 days. I've been in since 2017, and I've never heard of this. So let me know what you think about this in the comment section, but this apparently is a normal thing. 85-minute block interval left more than 13,000 transactions stuck in a pending state on Monday. According to on-chain data from several block explorers, the interval between the two latest blocks mined by Foundry and Luxor was 85 minutes, over an hour. According to Mempool, over 13,000 transactions were pending before the latest block was actually mined. And so we take a look at it, like, okay, well, this doesn't sound too great, but wait, it's not so bad. Last week, Bitcoin underwent a difficulty adjustment to ensure block confirmation kept taking place every 10 minutes. That's good to know. Mining difficulty surged to 35.6 trillion, the difficulty level. That's pretty high. It becomes more expensive to mine Bitcoin, which heaps pressure on a mining industry that is dealing with soaring energy prices and a crypto bear market. And we'll get into how much miners are actually selling right now. And Taj Draya, founder of the Lightning Network, tweeted that an 85-minute interval between blocks can be expected to happen once every 34 days, not taking into account any difficulty changes. So again, this is the first I've ever heard of it. And I just came across my desk and I was like, that doesn't sound right. But apparently, again, this is normal. I'm not a miner. That's just what they're telling me. Sound off in the comment section. But that's not the big concern for me. It's really not. I mean, 85 minutes, all right, didn't work out. There was no degrade of service, or there was not a denial of service attack, or there wasn't just a big collapse where there was a hack or there was a double spend or something like that. That would concern me, I'll be honest with you. But the things that I take a look at is, well, we know that's expensive to mine Bitcoin. What are the miners doing? And this is from Crypto Quant. We can take a look at just how much miners are selling every day. And this is what's called the Bitcoin miner outflow. And we can see that it's pretty consistent. And then we have spikes right here. But what's concerning to me is that the spikes are happening on the low points. And I think there's just so much competition. I mean, electricity is going up, let's be honest, across the globe. Wherever people are mining, hopefully they are in a sector where it's not so darn expensive. And of course, when there's peaks here, you'll see little, outflows, 8,000. If you take a look at 8,000, 5,000, the outflow itself, 1,000, then spikes here. It's been about 1,500 to 2,000 outflow. And if we kind of take a look back, let's go back here. It's pretty stable as time has gone on. Even over here, which was the peak, not too bad. And then of course, this was a big outflow. This is probably during the exodus for all the Chinese miners. Good. I'm glad you guys are here in America. That's probably why that happened. But then if we take a look even further back, let's just go all the way back to the beginning of time. Look at this one. Wow. 2011, a huge spike. But you got to remember, this was before the halving. So the first halving was in 2012. This is 16 November 2011. People probably were just selling Bitcoin just to gear up for the next hash wars, which happened over time. And of course, there was a lot more outflow back then because Bitcoin wasn't as expensive. But we can see here that there is a consistent amount of outflows. But the thing that I was taken aback by was this: the miner reserves. This is the balance of addresses that belong to mining pools, shown for large pools and aggregate unknown miners or a small. So all the mining pools right here, this is the miner reserves. And I'm just going to take it over here. It looks pretty flat, doesn't it? Just like we take a look over here, how these things look super high, but it's the nuances. If we go over here, all miners for their reserves is 1.91 Bitcoin, 1.91 million Bitcoin. And we haven't seen that low because it's been about 2.5, 2.4, 2.5, 2.6. It hasn't been that low below 2 million. Whoa. Since 2010. Let me go to 1.9. February 7th, 2010 to be specific. That's quite an outflow. And I'm not saying I'm blaming miners. They got to keep the lights on, right? But it is something to take a look at and say to yourself, are miners holding on? Well, they can't hold on. There's only so much they can do. So let me know what you think about it in the comment section. I want to talk about this story before everybody flips out and says, this is it. This is the crash. 85 minutes. But I think the real story is the outflow. And yeah, what do you think about it in the comment section? Let's move on to regulation. And this is from a friend of the show, Simon Yu, CEO of StormX. And he says, I thought Texas was pretty crypto friendly. And this is from Watcher Guru. Texas Securities regulator launches investigation into FTX US and CEO Sam Bankman-Fried. And it always sounds very concerning when we say it's an investigation. It sounds awful. And then Neville, my man, puts it pretty accurately. Texas is crypto friendly. And he's right. As long as they follow Texas laws, Voyager and FTX haven't been following the state laws. Hence the reason they're being investigated. But in all honesty, if we dig down into it, to the story itself, it's over on Barron's. And I linked in the description. You can check it out. It's a very long and dry, boring article. This is what it comes down to. The issue is this. At issue are accounts that FTX offers that pay investors yield in exchange for depositing their crypto with FTX. Regulators say those are unregistered securities that don't disclose their risk to investors. Stop paying yield. So I know some people will say, well, let them do whatever they want to do. Fine, that's fine. But you're just going to keep getting investigated. So I'm under the belief that these regulators are going to keep coming until we work with them. It's a lot easier to win the war when you have a Trojan horse and you can get on the inside. So just go like this. Just talk to the investigators. What's the problem? What do you want us to fix? Give us some clarity. Who's going to oversee crypto? Is it a security? Is it a regulation? Is it a currency? Really be nice to know that so you can give me the rules so I can bend the rules. And that's really the whole thing. Me personally, I'm done with yield. I don't care about yield whatsoever. All I want is my crypto. I learned my lesson on Celsius. I learned it on Voyager, just like Neville talked about. I don't need yield. All I need is dollar cost average and wait. And that's pretty much it. So let me know what you think about that in the comment section. I just want to bring that to everybody's attention. It's not a big deal, but that's what's going on. And then, real quick, I want to bring this up. Congratulations to Charlie. They just went live. The Oracle went live on the mainnet. If you don't know Charlie, it is an Oracle. It means it can take outside data, outside non-crypto data, and pull it into the blockchain. And that is Cardano's Oracle that they're using. So now that they are live, I just want to say congratulations. I know it was a long road, and good for them. So that will conclude that piece. And the last piece is a little long-winded, I must tell you. But just hear me out on this one. This one is pretty good. It's all about inflation, changing world order, and Bitcoin. And it was a very long article, but it was fascinating. I linked this one in the description as well. I highly encourage everybody to read it. This is Russell Napier. Who's Russell Napier? Good question. Author of Solid Ground Investment Report for Institutional Investors. He worked in the investment business for 30 years, been advising global institutional investors on asset allocation since 95. Author of the book of Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. Founder and course director of the Practical History of Financial Markets, course that's being at the Edinburgh Business School MBA, director of the Midwind International Investment Trust, advisory committee to two fund management companies, Cerno Capital and Kennox Asset Management. So needless to say, this guy's been around for quite some time, probably has a wealth of information. And what he talks about here, it floored me. So I'm going to get into it. First of all, this guy isn't the sky is falling guy like Robert Kiyosaki or the other ones out there. It's like, hey, the world's going to end tomorrow every day. This is not his MO. He wrote for years about the deflationary power of the world economy. But 2 years ago, after being pretty bullish, Napier warned of a vicious return of inflation. And guess what? I think he was pretty much spot on. if we have been paying attention to anything that's going on in the macro world, inflation's here. I think it's here to stay for a while. He explains why most developed economies are undergoing a fundamental shift and why the systems most investors have been accustomed to over the past 40 years. So the world that we live in right now, the financial world, it's changing. I think we have to change with it. And what he talks about is this. He says, here's my forecast. Everything that's going on is structural in nature, not cyclical. The idea that economies are guided by free markets is over. We're moving to a system where a large part of the allocation of resources is not left to the markets. The economy where the government plays a significant role in the allocation of capital. And we see that right now. We see that right now about what the government is doing. They're picking the winners. And they're also working with, of course, the central banks. The central banks, I think, are losing a little bit of power, and this is where it's going. He said the French would call this system dirigiste or dirigism, which is where the government takes over. This is nothing new. It was a system that prevailed from 39 to 79. Why is it happening? The main reasons that our debt levels have simply gone too high. U.S. is at, and James is always talking about this, is at 290% as far as debt to GDP. 371% is in France, and above 250% in Western economies. Growth, debt to GDP, pretty high. And then it goes over some other stuff. I'm going to have you read it. So this is what's interesting. What level of inflation would do the trick? And he talks about a range between 4 and 6%. Why 4 to 6%? Because it has to be a level that the government can get away with. So if we see that the government starts to pivot, not the government, excuse me, the Fed starts to pivot and says, you know what, we wanted a 2%, but 5% is pretty good. If they hit that, then we know this could all take place. And what he's talking about here is central banks and the weakness that they're experiencing right now. Is this all going to happen? So to the European Central Bank, definitely the Bank of England, the Bank of Japan. These countries are already well on their path to financial repression, which is going to be done by the governments. It will happen in the U.S. too, but we have a lag there, which is why the dollar is rising so sharply. Makes sense. I think if we take a look at the Dixie, it's still up. So what do you mean? Inflation rate in the area of 4 to 6%, what the government can tolerate, thereby achieving a nominal GDP growth of, say, 6 to 8%. While interest rates are kept at a lower level. Savers won't like it, because why would people like to save? Just like your parents and grandparents probably told you, just save your money, it'll be okay. Well, now when it's inflating away to 8%, so savers won't like it, but debtors and young people will. Wages will rise. Financial repression moves wealth from savers to debtors and from old to young, which we see right now, which is going on with the boomer generation. Imagine what will happen when we decide to break free from our one-sided addiction of having everything made in China. This means a huge home shoring or friend shoring boom, capital and investment on a massive scale into the re-industrialization of our own economies. Production can move back to Europe, to Mexico, to US, even the UK. And what he's talking about here, this is what he's talked about on yesterday's Q&A. This was from Jordan Schneider. Jordan is an analyst at our Hodium Group on China and tech. And this was a thread that he put out basically from this letter right here. Dear U.S. management team, as you may have heard, on Friday, October 7th, the U.S. government issued a new set of regulations prohibiting support to certain fabrications in China by U.S. persons, most of this being chips, microchips. As a result, U.S. employees, including U.S. citizens, green card holders, and foreign nations who live in the U.S. are prohibited from providing services to advanced fabrications in China, effective midnight tonight. And he just talks about how this is looking like a little bit of a take back of America and microchips because everything is being produced overseas. And this would actually fall into the CHIPS Act, which, if you've heard about this, essentially they're trying to do the same thing where they're trying to incentivize American companies to bring back the production of microchips here in the US and cut off China, which to me is fine. CHIPS Act. Micron Technology is the latest of half a dozen companies to announce new semiconductor fabrication plants in the U.S. 2 pieces. Did you know that we used to produce semiconductors up to almost 37%, almost 40% really in the 1990s. Now it's only 12% because we offloaded all the jobs, all the fabrication, and we just shipped it off elsewhere because it's cheap. But now we want to bring those back. The CHIPS Act signed a law by President Joe Biden in August, provides $52 billion for manufacturing incentives to boost microchip production. The U.S. chip manufacturers can begin seeking to use tax breaks and funds to offset construction and other costs beginning next year. And that's why these companies are saying, sure, I'll be a part of that. And that's what he was talking about in this section. So is this only the start? Yeah. He states we'll need at least 15 years of government-directed investment and financial repression, which sounds like what we're going through. But what will this mean for investors? This is the whole thing of what I'm trying to get to. What will this mean for me and you, right? This is good theory. So first of all, avoid government bonds, even though it's not too bad right now. Investors in government debt are the ones who will be robbed slowly. Within equities, there are sectors that will do very well. Energy, climate, change, defense, and of course, semiconductors. Inequality and dependence on products from China will all be solved by massive investment from the government. Companies that are geared to this renaissance of capital spending will do well. And he states gold will do well once people realize that inflation won't come down to pre-2020 levels, but will settle between 4 and 6%. And that got me thinking. You know, the gold market is around $12 trillion. $12 trillion for gold. I have nothing against gold and silver. I own them both. But I got to tell you, if you're going to do a hedge against inflation for a long-term horizon, not a short-term, let me make that crystal clear. I mean, we've got this thing. It's called Bitcoin. And there's other cryptos that you can get into. I'm on a ton myself. But this just brings it home to me. Every time I see this, you know what $20 in the 80s could buy you? A cart full of groceries. In 2000, not too much. Now go to the store and try to buy most anything with $20. You're going to be severely disappointed. And the same thing with Bitcoin. It's in the exact reverse. In 2011, you know, when miners were selling all their Bitcoin, one Bitcoin could buy about a cart full of groceries. And then 10 years later, gosh, $67,000 car if you sell at the top. That's a nice car, I must admit. So just think about this. What's going to happen the next 10 years in 2031? What could one Bitcoin be? And that's really all I want to share with you. So look, that takes everything we want to talk about as far as the news today. And if you got to go somewhere, thanks for sticking around. It's been 17 minutes, so I appreciate you. I really do. Now, if you want to hang out for a little bit, now we'll go into the Q&A. We'll answer all your questions the best of my abilities, especially all the stuff we just went over, and we'll go from there. But if you got to go, thanks so much for stopping by. Hit the like and subscribe on your way out. That's it. Thanks for stopping by. Let's get into Q&A. Oh, yeah, and one more thing. I just completed the videos for Cosmos or Atom and the Near Protocol staking on the Ledger. Those will all be out on Friday as I'll be traveling to Houston. So that is it. Let's get into the good stuff. This is my favorite part of the day. Favorite part of the